with agriculture today. And we're starting off our Friday program, as always, with Dan O'Brien, our grain market economist here at K-State. So Dan, thanks for being with us.
Thank you, Samantha.
Absolutely. So let's start off with our grain market report with our grain futures review. What have we seen in our grain futures this past week?
Well, I think what has the attention of most people is probably what happened Thursday. A major sell-off in soybeans. The lead July contract closing at $15.93, which is still a tremendous historically high price, but it was down 59 some cents per bushel. Wheat $10.05, also historically high, but at 30 down 32 and a quarter. Corn was down not quite as much proportionally, down to 7.46 and 3/4 for the July contract, down 21 cents. I think, as you and I had talked before we came on air, it's important to understand the context of those different price moves. You come back and look at corn first. Well, this fall that it happened, down to 7.46 and 3/4, basically still keeps us pretty much in the middle of the price trading range that we've been in since, in essence, since the last part of February, ranging from $7 to $8.25. So 7.46, pretty much in the middle of that. The last couple, 2-3 days, down some, but still not a major change in where we're at. More concerned though when you look at the wheat market, and again we're in the midst of harvest of the hard red winter wheat crop, and seasonal lows are not uncommon. Even if the crop is not that good, still you've got wheat coming that'll be sold. And if we come back and talk about that in terms of how farmers may respond to this, but you look at 10.05, and that's coming down, just touching on basically a $10 low that happened back around the 1st of April, just a few days ahead of that. So we are coming down towards historic lows, recent lows, excuse me, for the July 2022 contract, and that has concern for people that watch closely the technical side of the futures contracts. So whereas corn pretty much in the middle, we are down towards the lower end of the recent trading range for wheat. So that's of concern. For soybeans, somewhere in the middle. Basically, we had been trading in a range of about 15.60 up to just under $18. At closed yesterday at 15.93 and a quarter. So we're only 40 some cents above the lower end of the trading range, which extends all the way back to into February. So different reasons for that. I think there are some supply demand factors at play, and that would be the absence of China from buying grains here of late, particularly for soybeans. That's a big deal. But a lot of what happened yesterday, if we look at the overall factors, again, not a lot of grain supply demand changes. In fact, some very bullish things happening out in the world, but rather that as the financial markets are receiving signals from respected prognosticators that the likelihood of a recession in the U.S. is, it's a 50-50 deal. So they're at least that's what some folks some trading analytical houses that are trusted have been saying. So and that's of course having to do with high gasoline prices, inflation, the actions by the Fed, whole number of things. So it brings back something you and I talked about last week, and that what happens in the financial markets tends to bleed over. It tends to have impacts on the commodities, and it seems most of what happened yesterday is a response of the agricultural futures to what was happening in the overall financial markets. In the notes that we hand out each week, I do have on there a chart of the Dow Jones Industrial Index, as well as the on the oil market, and here we're trading at about 30,677, and we were at a high not that long ago in January of about 37 some. So you're down 20 some percent, and just a lot of concerns emerging about where the markets will go. And it's so with these drops, then people in agriculture are on the one hand, they're saying, well, our supply demand picture hasn't changed that much, but yet in terms of what people that are pricing our commodities are doing, they're dropping the price based on broader financial concerns. So the conundrum is, do we, when we do get, say, wheat now in hand and fall crops coming on, does that motivate people to wait for something better to come because they think the fundamentals probably supportive, or is this big systematic issue going? Does that compel them to more, quote, pull the trigger on cash sales? So I guess when you take a look at, since the wheat harvest is right upon us, look at cash prices for wheat in as of yesterday, June 23rd, in Salina, really kind of a bellwether market in the state. Highest cash price at the major terminals was $9.90. If you look at a week ago, that number was about 11.28, as I recall. There we go. It was 11.28 for a cash price in Salina. So we've dropped about $1.38. Now, on the one hand, the 9.90 is a tremendous price, but to see that recent drop probably weighing on the minds of decision makers as to where they sell. And also Hutchinson, another bellwether market, South Central, a week ago was 11.33 for a high, down also to 9.90 again. So who sells at a time like this? Well, anybody that has cash flow needs, people that don't have storage available on farm, and they've taken their wheat to the elevator, they hold on to that crop, they'll be paying some type of commercial storage amount, 4-6 cents or more, depending on where you're at. So you've got people that as they view the risks risks that are out there of continuing to hold and paying more costs, they may be compelled to store to store for a while. To go ahead and sell. But those that have storage or are more likely to view opportunities that could come down the road and as something to hold for, they may not be. This makes a lot of difference whether we're putting wheat in commercial storage or on farm storage. Commercial storage probably tend to sell quicker because of the higher costs. On farm will tend to be a little more circumspect about when we pull that trigger.
Some specific and important decisions for producers of ours to be making here soon. So I'm sure they're going to be watching these markets closely. So hopefully this is providing them with some insight. But we've also seen, you mentioned, some of the changes in the corn market futures, what we've seen, but some of that has to do with some of the weather we've seen too, right?
Yes, as you point out, we've had hot, dry weather for the most part for the last week or so. And by itself, without the financial markets, we'd be at least moving sideways until that worked itself out. There is a weather report that in about a week, within the next 6 to 10 days, that some moisture is expected in some key corn growing areas, corn and soybeans, basically. So that expectation is, I guess, something that's hoped for. Really, I think we're in a situation now where in the world we're hoping for good bushels everywhere because we're that tight for good yields. But that in itself is just one more factor that's kind of holding down any rally in the corn market. And note still. Even on yesterday's market, soybeans were down 59 cents, corn down 21. So they're still concerned about all this, how it works out. So I think we're in a situation now where if in a weather market view of the world, if those rains don't come to the degree that we're hoping for, then you've got support coming thereafter. So the market will be watching those weather systems to see if they actually deliver on the hopes and promises of moisture the markets will respond accordingly down the road.
Absolutely. And we'll have more, of course, on today's programming as well ahead with our meteorologist, Chip Redmond here at K-State. So he'll be covering a bit more in detail some of those weather reports here to come for the state as well. And then I know we've mentioned that we've really had a cash market response in terms of all that we've seen. So in terms of how we see this play out in the coming weeks ahead, is there anything of concern, particularly for producers, to think about?
I think, and this is something that prior to the start of the show, I neglected to mention to you. On June the 30th, there's a USDA acreage report that'll come out. There's also a stocks report that'll show what usage in recent quarters have been. We watch that mainly for feed usage, but that acreage report on the 30th has the potential to bring volatility to the market in either way. And been some expectation that perhaps corn acres will be a little bit higher than the prospective plantings report at the end of March had shown. So if that happens, that's a little bit bearish. If it should go the other way, in some people's minds, heaven forbid, then you're cutting down the likelihood of a strong U.S. crop all that much more. So that'll be a big day and big information that could bring volatility to the market. And as you look at cash prices, it's we'd be remiss if during wheat harvest we didn't talk about where things could go. I would think, building on what we had mentioned a few minutes ago, again, we can't probably anticipating a seasonal low here for wheat, and no doubt that's the general I guess narrative of the market. But we heard Antonia Broyaka out of the Ag-Econ department, other people around the world talk about the great challenges of getting wheat out of Ukraine, and also that we have major drought in parts of Europe. And that's also a major wheat supplier, that dry conditions in some in Russia. I think if you were to force Dan O'Brien to give his opinion, I think that the lows in the wheat market, as they stand on their own without the financial markets coming in, would be temporary. It seems we have enough strength and need for wheat around the world from a supply demand point of view, that the prices we'd see now will be temporary through the harvest time. And again, that's assuming the overall economy numbers don't wash everything away. But overall, I would think that we'll have strength in the wheat market post-harvest, at least nothing that would indicate major weakness in it. And so we'll see. If people have cash flow needs, they may sell their wheat, and that would be fine. These are wonderful prices. For those that aren't quite so constrained, you would wonder if they would hold their wheat crop for a little bit post-harvest and see what opportunities might come to them.
Absolutely. Well, Dan, that about wraps up our time that we have for today. But I know next week we're going to be touching on ethanol and kind of some of the trends we've seen there and how those will continue and play out through, our holiday season coming up on July 4th. So that's to look forward to. But thank you so much, Dan O'Brien, for your time this afternoon, our grain market economist here at K-State. That was Agriculture Today.
Thank you, Samantha.